Buy the rumor, sell the news. What it really means. There is a phrase in the market that confuses beginners and humbles professionals. Buy the rumor, sell the news. At first, it sounds backwards. Why would you sell when good news finally arrives? Why wouldn't you buy after confirmation? But markets are not built on logic alone. They are built on expectation, and expectation is what moves price. If you are a first-time investor, this is one of the most important lessons you will ever understand. The market moves before the event, not after. Step 1. Understand what the rumor really means. When traders say the rumor, they don't mean gossip. They mean expectation. For example, a company is expected to report strong earnings next week. A tech company is rumored to launch a new product. The Federal Reserve is expected to cut interest rates. A crypto project is about to receive ETF approval. Before the official announcement happens, investors begin positioning themselves. They buy early. They want to be in before confirmation. And as more people anticipate the good news, the price rises. Not because the news has happened, but because it is expected. The rumor phase is the anticipation phase. This is where price quietly climbs. Step 2, why price often falls. After good news. Now here's the part beginners struggle with. The news finally drops. The earnings are strong, the rate cut is confirmed, the product launches. And instead of exploding upward, the stock drops. Why? Because the move already happened. The price already climbed during anticipation. The good news was already priced in. And this is where smart money acts. Smart money understands that retail investors often buy at confirmation. They wait until the headline hits. They feel safe, they feel validated, but by that time, the early buyers are ready to sell. Smart money sells before the news. Here's a harsh truth for beginners. Smart money often sells the day before the news. Why? Because they bought during uncertainty. They accumulated during doubt. They bought when the outcome wasn't confirmed. And once confirmation arrives, risk increases. There is no longer mystery. There is no longer surprise upside. The event has happened, and markets move on anticipation, not reaction. So when retail investors rush in on the news, smart money quietly exits into that liquidity. Not because the company is bad, not because the future is doomed, but because the short-term trade is complete. They played the expectation, they sell the confirmation. Think of it like a concert. Imagine a major artist is coming to your city. Weeks before the concert, ticket demand rises. Prices climb, hype builds. By the time the concert day arrives, tickets are expensive. The excitement is already built into the price. Now imagine trying to flip tickets the night of the show. The upside is limited. The demand surge already happened. That's what buy the rumor, sell the news means. The hype builds value. The event releases it. A simple example. Let's say a company is trading at $100. Rumors begin that earnings will beat expectations. Over 2 weeks, the stock rises to $120. Everyone is excited. Earnings day arrives. The company reports great numbers, but instead of jumping to $140, the stock drops back to $112. Why? Because traders who bought at $100 and $105 take profit. They sell into the buying pressure from newcomers. The trade is complete, and profit-taking begins. Why first-time investors get caught. New investors usually wait for confirmation. They feel safer buying after good news. They want proof. But by the time proof arrives, the edge may already be gone. That's not always true long-term, but in short-term trading, it's common. Beginners buy the excitement. Professionals buy the uncertainty. There's a difference. Does this mean never buy good news? No. This principle applies mostly to short-term trades and event-driven moves. If you are investing long-term in strong assets like broad ETFs, Bitcoin, Ethereum, or strong growth companies, the long-term trend matters more than short-term news. But if you are trading earnings events, product launches, or macro announcements, understand this: the move often happens before the headline. How to apply this as a beginner? Let's make this practical. Don't chase vertical candles before big events. If price has already run aggressively into earnings or announcements, risk increases. Watch volume before events. Rising price plus rising volume into news equals anticipation buildup. Expect volatility on announcement day. Even good news can trigger sell-offs. Consider partial profit taking before major news events. If you are already up significantly, protect gains. Never assume good news guarantees higher price. The market doesn't reward logic, it rewards positioning. Why markets move on anticipation markets are forward-looking. They price in the future. When traders expect growth, they buy today. When traders expect rate cuts, they buy before the decision. When traders expect ETF approval in crypto, they accumulate before confirmation. By the time news becomes public, it is no longer new information, and price reacts to new information, not old information becoming official, the psychology behind it. This concept also ties directly into fear and greed. During rumor phase, optimism builds, speculation increases, volume rises, price climbs. During news phase, relief hits, traders lock in gains, short-term players exit, volatility spikes. The emotional climax happens at confirmation, and emotional climaxes often lead to reversals. When this principle fails, it's important to understand buy the rumor, sell the news is not a law. Sometimes the news is far better than expected. Sometimes price continues running, especially in strong bull markets. But statistically, over time, event-driven trades often peak near announcement dates. That's why discipline matters, not prediction, preparation. The bigger lesson for first-time investors. The deeper message isn't about rumors, it's about understanding how price moves. Price moves on expectation. If you learn to recognize anticipation phases, you avoid buying at emotional peaks. If you learn to recognize confirmation spikes, you avoid being exit liquidity. And that's what hurts beginners the most, becoming exit liquidity for smarter positioning, long-term versus short-term. If you are long-term investing in the S&P 500, the NASDAQ, Bitcoin, Ethereum. You don't need to obsess over every news event, zoom out. But if you are trading shorter time frames, understand event psychology, know when hype is building, know when hype is peaking, and know that smart money rarely waits for applause. They sell before the applause. Final truth, buy the rumor, sell the news. It doesn't mean chase gossip. It means understand anticipation. It means recognize that price often moves before confirmation. It means protect profits before the crowd feels safe. It means don't confuse headlines with opportunity, because by the time the news feels comfortable, the move may already be over. And in markets, comfort often comes at the top. Discomfort often comes at the bottom. Learn to recognize anticipation. Learn to manage emotion. And you will stop reacting to headlines and start positioning ahead of them. That is how first-time investors grow into disciplined builders, not by chasing news, but by understanding expectation.